What if your biggest investing mistake is not the stock you picked, but the rule you ignored? Because trends come and go. They look exciting. They make headlines. They make people feel smart for a week. Then they flip. And when they flip, they do not care about your feelings, your rent, or your savings goals. So in this video, I want to give you something stronger than trends. I am going to share the top 5 investing rules that matter more than trends. These are rules that keep you steady when the market gets loud. Rules that protect you from bad timing. Rules that stop you from doing something you regret at 2 a.m. after reading a scary headline. These rules work whether you invest for retirement, for a house, for your kids, or for simple freedom. They work if you invest in stocks, funds, or even crypto. They work because they focus on behavior, not hype. Let's get into it. 1. Always invest with a real plan, not a vibe. A trend gives you a feeling. A plan gives you a process. When people follow trends, they often follow the same pattern. They hear the name again and again. They see it rise. They feel late. They buy quickly. They tell themselves they will sell soon if it drops. But soon is not a plan. It is a guess. A real plan answers simple questions before you invest a single rupee or dollar. Why are you buying this? What do you expect to happen over time? What could go wrong? How long will you hold it? What will make you exit early? How much of your total money will you put into it? This matters because the market will test you. Prices will fall sometimes. News will turn negative sometimes. Your own brain will start creating fear stories sometimes. Without a plan, you will react. With a plan, you will respond. Think about this like driving. Trends are like speeding because the road looks empty. A plan is like knowing the route, the fuel, the time, and the rules. It is boring. It is also the reason you arrive. If you are investing for the long term, your plan can be simple. It can be a diversified, low-cost approach where you invest monthly and rebalance sometimes. If you are trading short-term, your plan needs even more rules because emotions hit harder when you watch prices all day. Either way, if you cannot write your plan in plain words, you do not have a plan yet. You have hope. So here's a quick test. If your best explanation is it's going up, you are following a trend. If your explanation is this fits my plan because of X, Y, and Z, you are investing. 2. Protect your capital first. Returns come second. Trends teach people a dangerous idea, that the goal is to win big. Real investing teaches a different goal. Stay in the game, because if you lose your capital, you lose your options. You lose your patience. You lose your confidence. Then even the next good opportunity feels scary. Protecting capital means you take risk, but you do not take reckless risk. You do not put money you need for life into something that can drop 40% in a month. You do not overbet on one idea, no matter how confident you feel. You do not confuse a lucky run with skill. A lot of people break this rule in 2 ways. First, they size their bets too big. They see a trend, and they go all in. They tell themselves it's a once-in-a-lifetime chance. That phrase should scare you. Markets are full of chances, but you only benefit if you survive long enough to take them. Second, they ignore downside planning. They imagine profit. They never imagine what happens if they are wrong. That is how small losses turn into portfolio disasters. Protecting capital can look simple, but it is powerful. It can mean diversification. So one bad pick does not crush you. It can mean keeping some cash for stability. It can mean avoiding leverage if you do not truly understand it. It can mean setting a maximum loss you will accept on a position. It can mean limiting how much you place into high-risk assets. People love to talk about returns. Few people talk about survival, but the market rewards people who survive because time is an unfair advantage. Time lets compounding work. Time lets you recover from mistakes. Time lets you buy when prices are down instead of when they are trending on social media. So if you remember one sentence from this rule, remember this. You do not need the biggest wins. You need fewer big losses. 3. Understand market cycles. Trends feel like the market is one straight line up. That is not how markets work. Markets move in cycles. Prices rise, then fall, then rise again. Growth periods feel easy. People feel confident. They take bigger risks. They start believing the good times will never end. That belief is usually a sign that the cycle is maturing. Then something shifts. Costs rise. Expectations get too high. Prices move away from normal levels. A correction starts. Sometimes it is mild. Sometimes it is violent. Headlines become negative. People start selling. The crowd that felt brave at the top becomes terrified at the bottom. This is where most trend followers get trapped. They enter near the top because it feels safe, since everyone looks happy. Then they exit near the bottom because fear's everywhere. The rule is not predict the cycle perfectly. That is not realistic for most people. The rule is respect the cycle so you do not act like every drop is the end. If you understand cycles, you stop treating volatility like a personal attack. You stop checking prices like it is a heartbeat monitor. You stop thinking you are smart in bull markets and cursed in bear markets. You also start making better choices during ugly periods. For long-term investors, the best behavior in a downturn is often boring. Keep investing in a disciplined way. Use dollar cost averaging. If you have a diversified plan, you let it work instead of trying to outsmart every headline. For traders, understanding cycles helps you avoid overconfidence. You realize that a winning streak can be the market being kind, not you being a genius. That humility keeps you from increasing risk at the worst time. This rule matters more than trends because trends are loud in the good part of the cycle, but they disappear when the cycle turns. If you build your investing identity on trends, you'll always feel lost when the crowd moves on. If you build your investing behavior on cycles, you stay calm while others react. For control emotions because fear and greed destroy more money than bad research. Most people do not lose money because they are stupid. They lose money because they are human. When prices go up fast, greed whispers, "Buy now or you will miss it." When prices fall fast, fear screams, "Sell now or you will lose everything." Trends amplify both. Trends make greed look normal. Trends make fear feel urgent. This is why experienced investors set guidelines before they invest, not after, before, because in the heat of the moment, your brain is not trying to protect your portfolio. It is trying to protect your feelings. Think about what happens during volatility. You log in, you see red numbers. Your body reacts. Your mind starts building stories. What if it keeps falling? What if I made a mistake? What if everyone else knows something I don't? Then you do something impulsive. You sell a good asset at a bad time, or you buy a hot asset after it has already ran up. You chase what is winning. You dump what is lost. That feels like action. It often ends badly. A strong rule here is simple. Build decisions around your strategy, not around your mood. That can mean you set rules for when you add, when you pause, and when you exit. It can mean you reduce how often you check your portfolio. It can mean you build a portfolio you can emotionally handle, instead of one that looks impressive. If you want a very practical method, try this. When you feel a strong emotion, delay your decision. Give it a set time, like 24 hours. Then recheck the facts. Ask what changed in the actual business or the actual market structure, not just the price. You are not trying to eliminate emotion. You are trying to stop emotion from driving the wheel. This rule matters more than trends because trends are designed to trigger emotion. That is why they spread. Emotion moves faster than logic. 5. Know your exit before you enter, then stick to it. Trends focus on entry. When should I buy it? What should I buy? Serious investing also focuses on exit because exits decide results. A lot of people treat investing like a lottery ticket. They buy and then daydream. They tell themselves they will hold forever, but they never define what forever means. Or they say they are long-term, but they panic sell the first time the market drops. A proper exit plan is not negative. It is professional. It answers questions like these. What price or condition means I was wrong? What loss limit am I willing to accept? What profit level would make me reduce risk? What time frame will I give this investment to work? What specific events would make me lose confidence in the thesis? This is not only for traders. Even long-term investors need exit thinking. just in a different form. For long-term investors, an exit might mean rebalancing. When one asset becomes too large in a portfolio, it might mean shifting risk as goals get closer. It might mean selling an asset when the fundamental reason you bought it has changed. For active traders, an exit plan is even more direct. Many use stop losses to prevent one bad move from wiping them out. That is not a guarantee of success. It is a tool for survival. The biggest problem with trends is that they encourage lazy exits. People say, "I'll sell when it feels right," but feelings are unstable. And in fast markets, feelings become panic. If you define your exit before you enter, you reduce the chance of emotional decision-making later. This rule matters more than trends because trends usually end with a hard reversal. If you do not know how to exit, you become liquidity for someone else's profit. Let's wrap this up. Trends change fast. Rules do not. The 5 rules you learned today are simple but powerful. Invest with a clear plan. Protect your capital. Respect market cycles. Control your emotions. Know your exit before you enter. These rules keep you steady when the market gets noisy. They help you avoid rush decisions and costly mistakes. Over time, they matter far more than chasing what is popular. If this video helped you like it, share it with someone who follows trends too closely. And subscribe for more clear, practical investing content.